Well, welcome everyone. This is a presentation that we do once in a year. We talk about how to find the hottest real estate markets. And even though that's the name of this presentation, we end up talking about a lot of different markets at the end of this presentation. So there's a huge list of markets, let's call it 200 markets at the end of this list. And I pick out some of the ones that I like. Today, I'm going to be picking out a city called Fayetteville. I want to show you just how ridiculous its numbers are. Fayetteville in Arkansas. So I'm going to pick that one out, but I'll talk about another 30 or 40 cities. I'll give you some tips, and I'll also bring up the two cities that we voted for, Grocapitus voted for as the best cities to invest in for 2024. So we'll mention those. They're not technically part of this presentation. They're part of a different presentation that we did a few weeks ago, but I think it's worth bringing up those two cities as well in this presentation. And typically what happens is I do this slide, the ones that coming up on screen, and we talk a little bit about ourselves, but I want to do this a little bit differently today. So I am going to show you this slide. So this slide, it just blows my mind. I want you guys to understand what has happened in the United States, because I don't understand why there aren't 1,000 headlines about this. Okay, so you look at this chart, right? So here in August 2020, a few months after COVID started, right? The average home price in the United States was right here, 74, right? So look back at how reasonably priced homes were in 2012. This is 2020, a few months after COVID. This is August 2023. The average home price in the United States is now close to 115K. And just so you know, in the last 4 months, that number has gone up, not down.
I'm sorry, Neal,
This is
that's not the average
mind-boggling.
home price. That's what buyers must earn to.
I'm sorry,
afford a home.
what buyers must earn. Sorry, that you're correct. So this is the earnings. Sorry. So in August 2020, you needed to earn 74K or 74.5K. Thank you, Anna. And today that number is shocking, right? So your income in 3.5 years, roughly, needs to have gone up by $40,000 to own a home in the United States. And that number for some of you who live in expensive cities may not be a lot, but this is the average in the United States, right? I'm going to show you what the number has gone up by in San Francisco. I live in the San Francisco Bay Area, and I used to live there, right? So this number is so mind-boggling that most people can't get their hands around how difficult it is to own a home, right? And so let me pick some cities, right? So San Francisco is obviously the poster child of how expensive it is. So in 12 months, the income needed to buy a median home in San Francisco has now gone up by $100,000. $100,000 in just this time frame, the last 12 months, right? So it's gone up from $300,000, which is outrageous, 300,000 median income, to 400,000 median income, right? It's just absolutely nuts. And there's so many places in the US where people are like, I don't need to live in San Francisco. I'm going to live in all these cities that are doing well. They have higher growth than the San Francisco Bay Area. What cities? There's nothing left. There's nothing left in the United States that is what I call inexpensive cities. Phoenix, you can see 121,000, right? Year over year, Phoenix is up 14%. 14% in a single year. Your income needs to go up 14%. Well, average incomes, according to ChatGPT, in Phoenix only went up 2.1% in the last year. US average, 115K. And it's gone up 15% year over year, right? And the median income of people that are actually buying homes is 75,000. So the gap is so astonishing. I cannot think of a time in the last 50 years, and please tell me if you know of a time that's better than that, where this has happened, this 3-year bizarre change. And obviously you think, well, prices will come down. They can't stay up that high. I mean, interest rates have been over 7% for 9 straight months. And during those 9 straight months where interest rates were over 7%, home prices have gone up. They haven't come down because there's no supply, and there's likely to be no supply for several years because of what we call the lock-in effect. My mortgage is locked in at 1.75%. So I really can't move, because right now if I move, my mortgage is going to go up from $5,000 a month to $16,000 a month. I can't afford that, so I'm not going to move. 30 million Americans are locked in. They can't move, so their homes don't come on the market, and so very little is on the market, so that puts a floor under prices. So as a landlord, and I'm not talking about investing with me and Anna, you can go do this yourself. I just can't imagine a better time to be a landlord, because we've now in 3.5 years completely destroyed any chances that roughly 18 million to 20 million American families had. I got that number from ChatGPT because the question I asked it is, what percentage of the United States in terms of families and what count are now priced out compared to the day before COVID? And the answer it gave me is it's likely to be 18 to 20 million families. But those 18 to 20 million families, they're not just priced out for now, they're forever renters. So while the US has a lot of renters, we just added $20 million, 20 million families to that number. That's mind-boggling. Not in my career. And I've been building real estate since 2003 when I built an office campus to buying real estate since 2008. I've never seen anything like this. And I just don't think it gets enough attention that this is a horrible thing for America and an amazing thing for landlords. So I'll start my presentation with that. For those of you that don't know me, Anna and I, we are syndicators, data scientists. We buy and build properties throughout the United States. We do all kinds of stuff: multifamily, student housing, self-storage, industrial. There's about 5,000 investors that attend our multifamily webinar series. There's hundreds of you attending right now. This is not even our most popular webinar because we do it every year. We share a lot of ideas and thoughts and techniques by
And
which you can go out and buy, and data, but by which you can basically go out and buy properties. Maybe you'll buy them with us. And these are examples of maybe a third of our portfolio, maybe a fourth of our portfolio. Our portfolio is about $1 billion as built. Or you can go buy them for yourself. I think what I tell investors, what I love to tell to them is, try at least to buy 1 or 2 single family rentals yourself. Don't leave all of your dollars in the hands of Neal Bawa or other Neal Bawas. Right? It's very good for you to be able to contrast being a landlord yourself versus investing into syndications with companies like us. I think that's a very good practice. So do both. And hopefully today will give you some interesting ones. But if you do them with us, I think you'll do well. These are just the average annualized returns that you can see. So in green, you can see what we achieved. In orange, you can see what we projected. And as you can see, these numbers have been absolutely phenomenal for the exits we've been having. Now, some of these exits, they were phenomenal for the primary reason that the market was very high. But we just had 2 exits, one in December, one in January so December last year, January of this year. And those were also phenomenal exits. And we're actually more proud of those because we had to deal with all that interest rate increases and the cap rate increases for those 2 properties. So very proud about the 2 exits, and we'll update this slide for you later. So as you can see, many of our investors, a lot of our investors are repeat investors. They've invested with us 2, 3, 5, 10 times, and they have good things to say about us in case you haven't invested with us before. Now, one of the things that we do is on our website, there's a testimonials page, and we have lots of videos from investors, and those are really worth seeing. So if you're considering investing with us now, you might want to go to grocapitus.com. That's the website right there, and clicking on the testimonials page. Just 2 cents for a lawyer. I am not an investment advisor, neither is Anna. So this is an educational webinar. Every investment involves risk. Be aware of your risk tolerance level. You're free to accept or reject all the investment recommendations that I'm going to make. I'm going to make a truckload of those today. And everything's subject to market risk. And that our recommendation is not a guarantee of successful performance. So do lots and lots of due diligence. And when you're done, do a little bit more due diligence. So don't invest your money on our recommendations alone. Housekeeping, we will send a recording of this out. It might get sent out tomorrow. It might get sent out on Monday. And that recording will actually have the PowerPoint deck that you're watching. And it'll also have the Excel spreadsheet that I'm going to be using throughout this presentation. So both of those will be in there. So just watch, look for the button that gives you access to those. And yes, we'll take questions at the end. All right. So we talked about this. $115,000 median income, 18 to 20 million more people that are basically forever renters, and that's what's created the opportunity. So when I was doing this in 2008, I'm a data scientist. So I started asking this question of, how can I compare cities in the United States against each other? How many cities are there in the United States? I didn't know the answer to that question. There's over 1,000 cities. There's 323 metros or MSAs in the United States. And my question was, I want to invest in the one that's the best. And people said, there is no best. You just sort of invest in the area that you live in. And I wasn't satisfied with that answer because that's not an answer for a data scientist. We don't think that way, right? I wanted to find out which cities were the best. And so I started doing a ton of research. And over time, I came up with a set of rules. These are not perfect. They're rules of thumb. They seem to work a majority of the time. Tens of thousands of people are using these rules at this point in time. In fact, there's 13,000 people taking this course right now on udemy.com, a little over 13,000 people. And so it seems to work fairly well for almost everywhere in the United States. It's designed for single family. It also works for multifamily. It's not designed for any other asset class. So don't apply it to self-storage. Don't apply it to industrial. Don't apply it to mobile home parks. Just single family, multifamily. And I think you'll have good success. So I came up with 5 rules. Actually, we came up with dozens of rules that we use internally. But the 5 that I'm giving you here are the vast majority of what moves the needle. So the others that we have moves the needle a little bit, but it takes too much time and too much effort, in my opinion. I think most of the real gold is in these 5 rules. So my first rule, as you can imagine, is population growth. And I'm going to give you some numbers, and they may seem random, but they're not. I change these numbers every single year. Population growth. If the city is between 250,000 people and 1 million people in population, most cities in the US that you would be investing in are going to be in that 250K to 1 million range, then you want a certain amount of population growth in that city. What is that number? Well, for this year, 2024, that number is 11.2. Next year, you can come to our website, grab this PowerPoint, and the number might go up, it might go down a little bit. So, and those numbers are between 2 specific years, 2012 and 2021. And before you tell me we're in 2024, I know. But what I'm trying to do is to give you access to publicly available data. And I've run simulations, and obviously there's nobody that can give you data for 2024 yet. We're at the beginning of the year, but there is data, some data available for 2022 and 2023. My experience is if I go out and spend thousands of dollars buying that data, I end up with the same list of cities. Why? Because population growth doesn't change over years. It changes over decades. Cities just simply don't, have massive spurts of population unless something bizarre is going on with those cities, like a new Amazon headquarters. Other than that, it's a pretty smooth level of growth. So the fact that you have access to publicly available data through Google only up to 2021 is not a problem. You're still going to end up with the same list of cities, whether you buy $2,000 worth of software or you get it from Google. All right, so large metros are different. So on the screen, you can see some large metros. For those, that number that I gave you, the 11.2%, well, it has to be about 7% in that time frame, because large cities don't grow as fast as small ones. Now, what about the cities under 250,000 people, right? I gave you the number for 250 to 1 million. Well, and then I gave you the number for cities over 1 million. Now I'm going to give you a number for cities below 1 million. And for below 1 million, the number should be 15% growth in that time frame. Why? Because smaller cities are riskier. Well, if you're taking the risk, you should have the reward. So you want, and there's plenty of smaller cities out there in the US, right? If you want to get the best, well, in that case, 11.2% is not enough. You want to go up to 15%. Now, this number that I'm going to give you, I'm going to show you how to use it, and I'm going to give you an Excel spreadsheet. It'll be really simple. You don't need to write anything down, by the way. So 11.2%, this number applies to the second half of 2023, because that's when we updated these numbers, and to the entire year of 2024. It doesn't apply to 2025. So a year from now, if you want to apply this, you'll come back here. We do this presentation. You can also send us an email, and we send you this deck with a slightly different number. My guess is 11.2 might go up to 11.6 or 11, or it might stay the same, but it's not going to move too much. All right. So that's the first number that I wanted to show you. And before I go on to the second metric, I want to show you, where do you get this number from? So I'm going to escape out of PowerPoint, and I'm going to open up a fresh tab. And I'm going to type in the following words: population, Columbus, Ohio. This is the city that I use for my example. It's really a perfect city to use for examples, right? And by just typing these 3 words, population space, the name of whatever city you're looking for, and whatever state you're looking for. So you could be typing in population Greenville, South Carolina, or population Myrtle Beach, South Carolina. That's fine, right? The same sort of chart that you're seeing on the screen is going to come up, right? Which is awesome, right? Now, you notice that this chart only goes up through 2021 because publicly available data on population growth is through 2021, right? So you can see this city, Columbus, there's a reason why I like it so much. I call it the jewel of the Midwest. That's because it beats the absolute crap out of every other city in its state. A lot of times I like comparing cities within the same state, and Google likes it too, because you're seeing three lines, a blue line, a green line, and an orange line. Well, the blue line's Columbus, and you can see it's going up. And the Cleveland is the green line. Not only do you see it going down, have you noticed something? Every time there's a recession, right? One here, Cleveland loses population to Columbus. So when the going gets bad, the people in Cleveland leave and they run towards Columbus here and then also here. You see this? These spikes that happen in Columbus mean that at that point in time, because Columbus continues to gain jobs during bad times and Cleveland loses jobs, people leave Cleveland. Now, the third city is interesting, Cincinnati, one of the great cities of America. You notice that this city basically is flat. Now, whenever a recession happens, people never leave Cincinnati. This is the definition of what is called steady eddy. If you like investing in steady eddy cities, Cincinnati is a great one and probably has good prices as well. But Cleveland, even though it has really inexpensive prices, may not be the best city to invest in, because do you want to invest in a city that is continuously losing population? And that the city that has been losing population continuously from 1990 to 2021, for 31 straight years, there hasn't been a year that Cleveland hasn't lost population. I want you to keep that in mind. Doesn't mean that there aren't good deals in Cleveland. All I'm saying is you may not get deals as good as you want. And my second and third data point, I call them real focuses, will really, really give you a sense of that, right? So within the same state, you can have cities that are doing really well, blue, Columbus, or cities not doing so well, green, Cleveland. And that's something that I emphasize, that the real estate is micro specific, right? The same thing's happening in Arkansas. Little Rock not doing so well, but Fayetteville, which is 150 miles north, is doing really well. And this happens all the time, so you have to be aware of it. And that's what the real focus system was designed. So how do you use it? Well, there's an Excel spreadsheet. You're going to get access to this. Well, I go in and I plug in two numbers, the 2012 population and the 2021. How do I figure that out? Well, very simple. I mouse over all the way to the right, and you see a number. You see 906,528. I'm going to type this in here, 906,528. Hit enter. And then population in 2012. I move the cursor back until it says 2012. And it says 812,872. So I'm going to go in and type in 812,872. You notice the population growth is 12% over this time frame. Now, what did I tell you it should be? What was the number I gave you? 11.2, which is why you notice that the cell in this Excel spreadsheet has turned green. Just nice visual impact saying, yep, thumbs up, right? So real focus number one, population growth. Columbus does really well. Cleveland obviously is going to do really terribly because there is no population growth. There's a negative population. It's losing population. So if you plug the Cleveland numbers in here, you'd get something like -6 or -5 or some number like that. And obviously that's not a very good number for data-based real estate investment. Not saying you can't make money in Cleveland. All right, let's move on to real focus number two. And real focus number two is about median household income. People need to earn money to pay rent. And preferably, you would want them to earn more and more money each year so you can keep raising their rents. So between a certain set of years, 2000 and 2021, so 2000 and 2021, you want a certain amount of income growth in a certain city. You want that income growth to be at inflation levels or close to inflation numbers. This is one of those cases where higher is better. So 50% income growth would be better than 35.8. But you don't really want to consider cities below 35.8%. Why? Because their incomes are growing so slowly that your delinquencies are going to keep rising. Because what will happen is people's incomes are growing slowly. You're trying to raise rents quickly. Well, they're not going to be able to pay you and they will become delinquent. And then you have to deal with evictions. So those 2 years, 2000 and 2021, we're going to show you exactly where to go. There's a website called City-Data. You're going to go there and look at the numbers. This number, 35.8%, it applies to this year, which means next year, It may be a different number based on inflation or things like that. You can always come and get it from our website. We don't have a paid service. We don't have a subscription. The data is always stored on our website. So that's number two. I'm going to also do number three, and then I'm going to show you how to use both of them. All right. So city real focus number three is median house or condo value. Median house or condo value. And I've been playing a lot with this one. I actually did a lot of simulations today. I went up a little bit to like 59 and then realized it was off, and I came back down to 58. So I've actually edited this slide several times today. 58% growth is what you want to see in house and condo value, right? So obviously you want the value of your home to increase. You're a landlord, you want that value going up. How much is enough? Well, between these 2 years, 2000 and 2021, once again, publicly available data, you want there to be a 58% increase in home price. And that's the minimum. Big, higher is better. 60% in this case would be better than 58%. And this applies to cities of all sizes. Could be a big city, could be a small city. It applies to all of them. And once again, this data only applies for this year. Do not use this number in 2025 because currently, because of inflation, home prices are going up. So it's going to change next year. All right. So before I go to real focus number 4, I'm going to give you a demo again. I'm going to say, okay, so let's look at real focus number 2 and find it somewhere. Let's go. I'm going to go here. I'm going to go to city-data. And once again, for the purposes of this exercise, I will type in Columbus, Ohio. My favorite demo cities. It's not my favorite city to invest in. You're actually going to find out what my favorite city is in about 15 minutes. But Columbus is a really nice city to invest in, the jewel of the Midwest. All right, so here, I'm going to make text a little bit bigger, easier to read. There. All right, so let's go down here. So all I'm doing is typing in Columbus, Ohio. I go to the next page. There's a bunch of pictures of Columbus. I skip those. I scroll down a little bit. And here, I come across this section. Do you see this section here? I'm highlighting it for you, right? Estimated median household income in 2021, about 58 grand. People are earning about 58,000 in median household income in Columbus. Was $37,000 in 2000. So you notice there's a 2021 number and a 2000 number. As you can imagine, all you're doing is grabbing this number and plugging it in here, right? So I'm going to go 58,202. And then I'm going to grab this number, 37,897. It was already in there. And you notice that the median household income is up about 54%. I mean, you might say, ooh, 54%, right? That's a lot higher than my 35.8%. Yeah. Because that 35.8% is a little bit below the average for the United States. And Columbus is going an entire 1/3 faster. So its incomes are growing not at a 2% annualized rent bump increase. They're growing really for 3.5. You might even get 4% rent growth. In my world, 4% rent growth is absolutely astonishing. So that's a great number. And Columbus is doing really, really well on real focus number 2. Let's figure out how it does on real focus number 3, the median house and condo value. Where's that information? Same website. We had plugged in Columbus, Ohio, and we were right here, right? We were on this line. Well, if you look down 2 inches, you see this, and you see 2 numbers. The median home in Columbus is still very inexpensive, $219,000. That's cheap. That's cheap, right? 2021. What was that price in 2000? Well, it was less than half. It was 99,000. So once again, I'm going to take that number here. I'm going to take this number here, and I'm going to plug it into the spreadsheet. I'm going to scroll a little bit into the right. So 99,100 already in there. And then here, I'm going to plug in 219,200. And I'm going to hit enter. And wow, look at that number, 121%. That's the price increase over that time frame. You're like, oh, that's not hard. There's a lot of places higher than that. They are, but there's a lot of places that are not. Would you like me to show you an example? Let's go look at Cleveland. So we're going to go same state, Cleveland, Ohio. We're going to hit enter, and we're going to scroll down. And now we're going to pick up that income number for Cleveland right there. And we're going to say, okay, so this was 25,928. So I'm going to go plug this in here, 25,928. And then we're going to plug in the higher number, which is for this year, 35,562. You notice that the median household income growth is 37%, which is lower. So it's below this bound, right? Well, almost at that bound. So it's about there. So Cleveland's okay. But what about this number? Let's take a look at this number, the third one. So it's 83,400. So I'm going to plug in 83,400. Remember the number for Columbus was 121%. Now I'm going to plug in 71,100. And you're going to be shocked that when Columbus grew by 120%, Cleveland only grew by 17%. That, my friends, is the impact of population. Because there's so many people leaving, there are so many empty units that there's no inflation in home prices. 17% is awful over 21 years. Because think about it, inflation is 2.5% in the United States. In that time frame, you should have at least gotten 45, 50% home prices just to keep up in inflation. So not only are values not increases, on an inflation adjusted basis, Cleveland is losing value. Your home that you bought for rental is earning you cash flow, while at the same time, its value is going down every year on an inflation adjusted basis. Do you see the difference? It's stunning. It's shocking how big that number is, that the gap is. And both cities are in the Midwest. They're both in a state that isn't growing. Ohio's not known for its growth, by the way. But one of them is a growing city, and the other one is a city that's not growing. This is why data-based investing tells you so much. You could be earning zero cash flow in Columbus. If you had held the property for the last 10 years, you probably tripled your money because the properties have increased in value so much. All right, so we've now had 3 different metrics. We've looked at population, we've looked at home price growth, and we've looked at median income. Let's look at number 4. And number 4 is right here. And that is, whoops, next one. And that is change in crime level. So when I was looking at this, I use a statistical, well, I used to use a statistical analysis called R. Now you can do this on the web in Tableau. And R would basically, it allows you to enter 2 pieces of data or 2 sets of data and basically say, what is the correlation between these 2? A high correlation is a number close to 1. So if the correlation is 0.99, you can say these 2 things are very highly correlated. If the number is 0.5, well, there's a little bit of a correlation there, but they're not really that correlated. So when I started looking at crime and trying to correlate it with real estate profits, right? So you get real estate profits from a place like Zillow by looking at how much home prices increase over time. So that shows your profit. And then what you do is you're looking at crime in that city. There was very low correlation. It was maybe like 0.5, 0.6. And I wanted something that was 0.9, 0.95, very as close to 1 as I could get. After a lot of fiddling, what I realized is that profits in real estate are not correlated to crime. You can have plenty of profits in high crime cities. They're correlated to change in crime. If crime goes down in a city over time, profits go up. And it sort of makes sense, but it took me a while to figure that out because I was just like, wait a minute, Memphis is a high crime city. Therefore, you can't make money there. Oakland is a high crime city. And it turns out Oakland and Memphis, I'm not saying they're good cities to invest in, but they may be fine as long as their crime stays stable. If it goes up, that's bad. If it comes down, well, it needs to come down at a certain speed. And that's what this number on the screen is, below 450. Because on that same page that we were there a second ago, city dash data, on that same page, there is a crime table. Let's go look at it. I'm going to go back to Columbus, by the way. So let's go to Columbus. Oops. I'm going to scroll, and I'm going to keep scrolling for a little while until I see a blue table. Blue table. There. And I'm going to make this a little bit bigger because I want to see as many years as possible. Oops. And bigger. There. Now, you notice I'm going to make it a little bit smaller because I actually want to see more rows. There. All right. So now if you look at the screen, it's showing you data all the way to 2020. So unfortunately, crime data is a little bit out of date. And it's showing you data as early as 2007. Now, one of the coolest things about Columbus, and this is, by the way, highly correlated with education. You might say, why is one of your numbers not education? Well, firstly, you're buying this property for rentals, and renters care a lot less about education than people that are buying these homes to live in them. But what you might find is I do have education in my list. Education is inversely proportional with crime. As education levels go up, crime goes down. So I've factored in education through change in crime. Now, I want you to ignore all of the numbers in this table, the murders, the rapes, the robberies, the assaults. Ignore all of those. Just look at the last line, the blue one. Last one. This is a city data crime index. It's very similar to other crime indexes, right? And so you can see it's got a number. And this number, you want this number to be lower than 450. And you also want it to be smoothly decreasing. Lower than 450 and smoothly decreasing, but not this number because that's 2007. You want to look at the latest number, and you notice Columbus is now lower than 450. So this has been a very sketchy, high crime city that has evolved through education and healthcare investments over the last 20 years. And it's gone very smoothly from 673, 624, 591, 582, 567, 513 into the 400s, 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 and now into the 300s. You see how there's a slow, but not slow, a reasonably quick decline in crime because we went from 673 to 376. That's low. I mean, any city that's below 450 for crime is doing really well. But once again, it's not the number, it's the decline in crime. So from the left side to the right side of the blue line, you want to see numbers dropping. Because if they stay the same, even if it's low crime, you're not going to get the same benefits for your real estate investment. You need to see a decline over time. And you might say, really, can cities keep going down? Yeah, there's cities in the US where the number is 200. 200. That's right. All right, so that's number 4. And you can also plug crime in here, real focus 1. So you can basically plug in, what was the number for Columbus? Let's take a look again. So it was 376 and 673. So I'm going to plug in 376, and you're going to notice the cell will say green, and this number is 630, 673. And look at that change. Look at that crime reduction over 15 years. That's huge, 297. If this number was even 200, that's a lot of crime reduction. That's a lot of not so good people leaving and good people moving in. So once again, a good city to invest in because it meets the real focuses. All right, that's real focus number 4. And let's finish off with the final real focus. And real focus number 5 is, I'm not going to tell you, because before I talk about real focus number 5, I want to share one of our projects. So this is a project that I've been working very hard on. Anna's been working very hard on for a number of years. And I want to just share something about this project with you. So one of the cities that does incredibly well on real focuses, shockingly well, actually, is Idaho Falls. It does much better than Columbus, by the way. And Idaho Falls is in Idaho, which is either the fastest or the second fastest growing state in the US, depending upon which year you look at. And Idaho Falls is the only city that I'm aware of in all these years of looking that has won Milken Institute's City of the Year award 3 times. And it won it 3 times in just 4 years. There's over 1,000 cities in the United States. So you can imagine how hard it is to win one single time. The Idaho Falls is the winner for 2024, 2022, and 2021. 3 times out of
2023, and 2024.
2021. Okay, I missed 2022. So 2021 was runner-up in 2022.
Yes.
Came in, number 1 again in 2023, and just won again a few weeks ago. So
and we, based on our data, saw it in late 2022 and bought land there.
Right.
In 2020, late 2020, and bought land there in late 2020 and started developing.
Once again, you can see how our metrics work, right? So Milken didn't rank it in the top 5 until 2021, but we had already purchased our land in 2020, and you'll actually see that property in pictures in a second. So This area is going gangbusters. Just take a look at this neighborhood price appreciation. This is 3 years. Now, Real Focus was talking about price appreciation over 20 years of 58%, correct? Well, this is 3 years, not 21 years. In 3 years, this neighborhood has seen 58% price appreciation. I mentioned it for 21 years. So amazing. And look at that income growth, right? So 21% in 2 years. These numbers are kind of weird, but Idaho Falls is an incredible market, right? And this is a project that I've been baking for a long time. In April of 2022, we're now in March of 2024. I wrote the letter of intent, and then we ended up, Neal and me and Anna invested $2.3 million of our money. That money's been in there for a while, almost a year at this point in time. Before that, we were spending hundreds of thousands of dollars getting it shovel ready. So now at this point, it's zoned, it's permitted, it's got city approvals, and we're almost at the point where we've started horizontal work. So this last box is going to be checked off in the next month or so, but this is not live. You're just watching a preview of this project. It's not available for investment. So I love this place because the net in migration is stunning. Their taxes, very low. Their insurance, very low. Their construction costs, shockingly low. All of those three lead to higher net operating income. And I really, really love having high net operating income. So obviously this is not our first community there. As we mentioned, we bought land in 2020, but built all the way through COVID, and you can see the finished community. This is 66 units. The rents are about $1,700 per unit, and it made a lot of money. Here's a top view of the community. You can see a central park. There's a barbecue area. There's a playground here. Actually, this is the barbecue area. This is just sort of a fire pit area. And then there's a dog park somewhere. There's parking in the back. Everyone also has, as you can see, some people like to park on their in this area, and some people, as you can see, park in the back. Everyone has a 1-car garage. We don't do 2-car garage. These are all townhomes, and we like building townhome communities. So the new one's also a townhome community. Here you can see in Idaho Falls, the local folks will come in and they'll custom build cabinet. This isn't Lowe's. This is custom built cabinetry. Here's a close view. Beautiful granite countertops and 9-foot ceilings. You're able to get so much for your money here. It's just shocking how much you get for your money. Large bedrooms. Look at the bathrooms. Once again, granite. Look at the tiled stuff that's going up. It's just amazing how much you can get in here. So it was a very successful project. It was very profitable. Its numbers, looking at it from a syndication perspective, equivalent were 2.67x, an AAR of 41%, or average annualized return of 41%. So we looked at this and said, let's do it again, because the city doesn't seem to be going anywhere. It continues to win Milken's best performing city. And most people don't even know where the heck Idaho Falls is. And nobody knows what Milken is. And I'd prefer to keep it that way, except, the group that comes to us. There's 2 million real estate investors. If 1,000 of you know, that no big deal. So this is something that will be available for investment. We can't give you all of the numbers. We're still working on them. In a few weeks, you'll know they're going to be fantastic. These are townhomes, by the way, for rental. These are some of the pictures of the property once it's built. These are renderings, of the property. It'll look beautiful once it's done. All right, that's that. Let's go back to real focus number 5, and we'll also start talking about cities. And real focus number 5 is 12-month job growth. Ideally, I want you to look for numbers above 2%. So if you want 2% annualized job growth, 1.5% for cities that are above a million. So like Los Angeles, hard to get to 2%. But 2% is great, 3% is phenomenal, 4% is absolutely incredible, right? So this number actually, hang on, this is already done. So this would have been for the rest of 2023. It's actually, I'm going to change this to applies to 2024, because there was this rush, of employment as people are coming back from COVID, and that is now over. I'm glad to see that the job numbers have stabilized. Now, this data is on this website, departmentofnumbers.com/employment/metros. And you're like, I'm not going to remember that link, Neal. That's okay. You're going to get this Excel spreadsheet, right? I showed you this Excel spreadsheet. Well, the link is in the spreadsheet. Right. Where is it? I don't know why it's not in here. All right, I'm going to add that in and make sure that the spreadsheet that goes out has the link for you, right? So departmentofnumbers.com. Let's go take a look. DEPT, there it is. So here's this link. Now, the first thing I want to tell you is this is an ugly looking page, but it's very powerful. So just ignore the fact that it's not ugly. The government doesn't do a good job of basically posting these kinds of things. So first thing I want to tell you is do not look at the monthly numbers. The monthly numbers will lead you in the wrong direction. One company opens up, one company goes under, those numbers go up and down. It's crazy. Never look at the monthly numbers. You always look at these two numbers, the number of jobs added in a year, and then the percentage change. Okay, both are important, and I'll tell you why. So the first thing I want you to do is, you see this last one, the percentage change? I want you to click it twice when you're on this page, right? I know you're not there now, but click it once, and you will see the cities that you don't want to invest in, because even though the US is growing robustly, we've had a fantastic job growth year for the last 12 months, these cities are losing jobs. You cannot make money if you're investing in a place that's losing jobs. You can make money in a place where it's losing population as long as the population growth loss is slow. But you cannot make money if jobs are being lost, because for every 1% job loss, you're losing 5 to 15% in rent. It's a shockingly large number for just a 1% drop in jobs. So click on it once and then click on it a second time. Now you notice all these cities, you see a lot of cities that are above 3%. Now you see some outliers, and I'm going to mention some outliers to you and tell you that these are problematic places. So Ocean City, New Jersey has a lot of transitional jobs, which is why often you see it at the top of this list, 9% up, 9% down, but then also some months of the year you see it at -9, -6. So it's very transitional. The place itself is transitional. There's some hotels opening up there. So I would steer clear of this one. I would also steer clear of Lawrence, Kansas. But beyond that point, you start seeing some really good numbers. So Anna is a Airbnb super host, and she has properties in Charleston, South Carolina. Highly recommended. We currently are making an offer on a property in this amazing corridor that goes from Charleston to Myrtle Beach. That corridor, and I've been saying this in all of my podcasts. If you're listening to my podcast, you already know this. The corridor between Charleston and Myrtle Beach, something interesting is happening there, right? So sometimes the corridors just do well, and it's a 2-hour corridor. There's some small cities in the middle, but one side's Charleston, the other side's Myrtle Beach. You can see just how shocking this is. For a city as big as Charleston to have a 5.77% job growth number, this is rare. We don't see numbers for big cities over 5%. Sometimes we'll see it right around 5%, but 5.77%, that is a huge, huge number. Now,
I just wanted to add, Neal, for Charleston, because I was just looking at the 2024 Milken Institute report. It came in as number 11, which is a big deal for Charleston.
Huge. That is, again, an amazing number,
For the
right?
big city side of the world.
Yeah,
That's big.
it is.
Charleston.
It's doing really well. And here's what I'm going to
super
say. I think it will be in the top 5, because if these are recent job numbers, and Milken sort of looks at a lot of different things.
Yeah.
So if it's at 5.77% right now, I'm going to say it's going to be in the top 5 next year. Top 5, right? Amazing market. Yes, you've got to deal with the insurance issues. You've got, high insurance costs because it's on the shore there. But other than that, an incredible place to invest in. Now I'm going to skip past Mankato MN. And the reason for that is I've never seen it before in this list. So as you can imagine, I look at this list, every month for the last 10 years. So I've become used to kind of knowing which cities turn up again and again. But in all the years that Anna has been looking this, Anna, have you ever seen
I've
Mankato?
never, I didn't even know
I
that
have
existed.
no idea. So I'm just going to
Never heard
skip
of it.
that. Right. This next city is the most dangerous city in this list. It's
Yes.
highly, highly dangerous, and you'll often see it at 5%. In fact, I'd say probably 2/3 of the time it's going to be at 5% or even more, 6%, 7%. Well, that's because Midland, Texas is part of the shale patch. So it's in the Permian Basin in Texas. And in that area, if the price of oil goes up above 80, you start seeing massive growth numbers in Midland, Texas. But if the price of oil falls below 72, 73, then you start seeing negative 5%, negative 10% numbers. So this is an oil town, and it goes up and down based on the price of oil. So a very, very dangerous place to invest in. I strongly suggest you stay away. Salinas, California is usually a steady Eddie market, so we don't see numbers as high as this. Not sure what's going on there. So I'm just going to say maybe not a market that you want to look at. But Lexington, Kentucky, we've been talking about Lexington in our meetings, right, Anna?
Yes,
Comes
we
up
have.
again and again as a very interesting meeting. Now, as city. Now, I want to point out to you, Kentucky is a small state, right? There's like 6 people living in Kentucky, but and Lexington is the largest city in Kentucky, but still a small city. Well, in a small city, look at the job gain. So it's not just the percentage. Look at this number. 12,000 jobs. 12, 4% is easy if it's 2,000 jobs, but 4% is hard when it's 12,000 jobs. So I can't say something is going on in Lexington. I'm going to say something very big is going on in Lexington for the city to gain 12,000 jobs in a single year. That is a big number. So obviously you can see other cities gain more jobs, but those cities are much larger than Lexington, right? So a good city to look at if you're near Kentucky, you might want to take a look at that. Trenton always does well. Usually tends to be around 2%, a good city to invest in. Durham is better. So Durham is just about the same number here. You can see more jobs than New Jersey. Durham is part of the metro that we picked this year as the best city in America to invest in, which is Raleigh, Durham Metro, right? So we picked Raleigh, North Carolina, but as you can imagine, Raleigh is a bigger city. Durham's a smaller city. They're about 20 minutes away from each other, but Durham is part of that metro. And so you can see the numbers here are incredible. You can see Raleigh down here as well. So 3.83. These are just shockingly high numbers because Raleigh is a big city, 1.7 million people in the metro. Raleigh's about a million people. So when a city that's a million people is 4% job growth, amazing. That is absolutely stunning. And to see that job growth also extends to Durham, which is actually doing even a little bit better, these are just stellar numbers. Boise is an incredible city to invest in. Boise has been picked by us twice. So it's one of the rare cities to have been picked twice by us as City of the Year. But the challenge is at this point, Boise has extreme affordability issues because its income haven't caught up with home price increases. So we suggest for the moment, you might want to stay away. If you listened to us back in 2017 or 2018 when we were talking about Boise and bought there, I'm sure what you bought has more than doubled in 5 years. Las Vegas, this is actually a city that's doing really well at this point of time. I see it in the list a lot. As you know, it's a little bit of a boom and bust town. So you might want to keep an eye on the prices and the rent prices, but otherwise, Las Vegas is doing really, really well. Fort Collins is better than Denver. Fort Collins, in my mind, is better than a few other cities in Colorado. I would say at this point, it would be my favorite city in Colorado to invest in. I'm not enamored with Colorado as a state, but if you live there, this is definitely a place to look at. Jacksonville is in the list very often, so it's a perennial growth city. The only challenge with Jacksonville is it has a large number of units delivering this year, so rents might be negative. But if you're in for 5 years, you couldn't go wrong with Jacksonville. Charlottesville is beginning to show up in our list. It's not very consistent, but if you live in Virginia, a state that has 3.69% in job growth is going to do really well. I'll skip it over. Cape Coral is absolutely fantastic. Don't just look at the 3.65, look at how many jobs. We're not talking about 2,000 jobs. We're not talking about 4,000 jobs. Cape Coral has now gained 11,000 jobs in a year. Just astonishing, astonishing city. Highly recommend that you look at Cape Coral. Now, again, you're going to have to deal with high insurance. I'll skip Jefferson City. I'll skip San Luis Obispo. I don't see them often. Huntsville is a terrific city to invest in. Once again, a lot of supply there, so you might see negative rent growth for this year. But on a 5-year time frame, there is no city in Alabama that is as good as Huntsville. Highly recommended. Gainesville is it's more of a agricultural town. So it's going through an agricultural renaissance. It's about 112 miles away from Atlanta. sort of in the northeastern direction, does fairly well. We have, Anna, correct me if I'm wrong, I think we've made offers on maybe 2 or 3 properties on Gainesville over the last 2 or 3 years, and we've never won any.
That is correct.
Yep.
And I want to say that Gainesville, Georgia showed up gangbusters in the Milken Institute report, Neil. I was just reading
Nice.
it.
Nice. Yeah.
Georgia, ba-boom.
Wow. Wow.
Yeah.
Anna has read this report because
No. I
she
just like
found it.
literally just saw it and was
Yeah.
scouring it before. And I just want to say, since I just brought this up, Raleigh, North Carolina, #2 for big city.
Number 2. Wow.
Number
Wow.
2.
That's
Yes.
again, it's astonishing that we basically in a January presentation picked Raleigh as our city of the year.
Yes.
Milken
And
comes out,
February
Milken always
6th.
comes out too late for us, right? So
February
we do our
6th, it was
presentation.
picked by
Exactly.
Milken Institute.
I know. So it's just stunning how the math really makes sense. And that's why
The
we
data
have
is the
such high
data,
belief in
right?
the
If
data is the
anyone's
data.
looking at the data, you can't ignore it.
Yeah, and we have a friend of ours, Vicky, who's listening to us today, and Vicky was there for that presentation, right? So Vicky, we picked it like 2 days before, right? Before the Milken Institute came out. So very excited when this happens, when there's congruence between our data and somebody that has 10 full-time employees just turning away at the data. So I'm just going to go through, you're going to notice that I'm going to skip some cities. Ann Arbor is a very interesting city, high growth, but it's also very expensive. So there's a second city that I like to look at, which is Grand Rapids, Michigan. It has a lower growth in terms of jobs, so it's in the 2s, but it has reasonable prices. So we picked Grand Rapids as our up and coming city of the year for this year. We've been looking at it for a while. Another city that's in this list that I'm getting used to seeing constantly is Sioux Falls in South Dakota. So highly recommend that if you live around this area, Sioux Falls is doing extremely well. Now, Carson City is part of the Reno area, and that area is doing incredibly well. I'm not sure if I'd invest in Carson City. I'd probably stick with Reno, but they're about 10 miles apart from each other. Dallas is a big city. It's perennial favorite. Usually is in the 2s because it's a very large city, so it's hard to get into the 3s, but it's in the 3s right now. But the number one highlight of this list is this one right here. Fayetteville, Arkansas is part of a 500,000 person metro. That includes the cities of Bentonville, Fayetteville, Springville or Springdale, and then there's a 4th city, I can't remember what it is, Rogers. So that metro, which has these 4 cities, is just going gangbusters in every different way. So in my mind, within 2 years, you're going to start seeing it in the Milken top 10. So this is a early identification.
My
We're
friend,
saying
number
yeah.
7, in 2024 in the Fayetteville is number 7, beating.
Wow. Oh my God. Oh my God. Wow. This is thrilling. This is incredible. I mean, we've been making offers and losing offers. By the way, we had an offer, we got a property, and then we had to sort of get out of it because all bad stuff happened with interest rates. So so we had to and that property was in Rogers, which is the next city over from Fayetteville. But that metro is incredible. I urge you, go there, buy something, because I think they're set for a 5-year run. And I'm even more excited to see that it was picked as number 7 city
number 7
by Milken. So check that out. McAllen, Texas is benefiting from the return of manufacturing. No, manufacturing is not returning to the United States. It is returning to Mexico. And McAllen is one of the 2 waypoints for goods to come in from Mexico into Texas. The other one is San Antonio, which, there's 2 freeways. One goes to the city of Monterrey in Mexico. The other one goes through McAllen into Laredo. So that area is booming, and it makes sense. I think it's going to do really well for industrial. Let's skip some more. Miami, big city, just amazes me. I think their home prices are shockingly high, but they continue to generate job numbers like this. Austin is a perennial favorite. I believe that Austin was Milken's City of the Year, correct?
Yes, number 1.
That's right. So amazing city. Not going to do well on rents. It has the largest amount of inventory coming into any city in the United States this year, so its rents are going to be negative. But you might want to pick something up in Austin at the end of the year, because that's probably when you'll see the lower prices. Coeur d'Alene's doing well. Reno's doing well. We talked about those. Let's see what else in the list is super, super exciting or interesting to me. I'm just going to keep going until I see a city. San Antonio, fantastic. Look at that, 2.6%. The big city, 1.5 million people. And for it to have this kind of job growth, it's doing something right. Boom, boom, boom. See Columbus, but this is a different Columbus. Atlanta, always doing well, 5 million people. And to be doing 2.5% of job growth at 5 million is phenomenal. Indianapolis, we've been talking about Indy more and more. We also gave Indy our upcoming City of the Year award in 2022. Just phenomenal. Indy just seems to be doing everything right. This is a city that we invest in. One of our favorite properties is in this city, Dalton, Georgia, the carpet capital of the world, doing quite well with job growth at 2.37%. And let's see. Salt Lake, Grand Forks, Orlando, yeah, doing well, 2.25%, 1.7 million population for the Orlando metro, and for, an area, well, actually, sorry, I've got that wrong. 1.7 is Raleigh. 2.7 million people live in Orlando, Florida, and for a city of that size, look at that, 32,000 jobs. That's a lot of jobs in a year. 2.25, they're doing something right. We also mention often for people that live in Washington, the best place to invest in Washington is Kennewick, Washington, in the Tri-Cities area. Small place, but really awesome. It's been on our list for a very long time. And now that I'm getting into the twos, I'm less excited about some of these places. And so we'll stop here. If you have questions about other cities, feel free to ask us. We'll answer them as quickly as we can. But that's our presentation. Remember, 5 things. 1 Excel spreadsheet. Once you do this, people tell us it takes them 10 minutes, and they randomly pick 2 cities in the US, repeat the 5 steps, takes about 10 minutes, and the insights that they get are just absolutely mind-blowing, right? We picked Provo in 2017 and 2018. Milken picked it as well twice. Provo has won twice. No longer sort of as ultra hot as some of these other places are. Because the home prices have gone up a lot. So that's our presentation, and feel free to ask us questions about your cities.
Awesome, Neal. Well, let's start with some questions. Any rules or systems to finding good neighborhoods within the cities?
Yes, and I believe that I believe that the course that we have up on udemy.com, so just type in Udemy space Neal Bawa. It actually gets into the neighborhoods, so it goes further. We want to do a 45-minute webinar. We were already at 6 o'clock, so we've already been at it for an hour, but it gets into the neighborhoods, so you can go and watch the course. It's free.
Did you consider cities and towns where major universities are located in your analysis?
The answer is I don't need to, because it shows up in the job data. It shows up in the income data. So it shows up by default. It's fairly common for those to do well. For example, on the screen, you see College Station. College Station is a major college town. It is roughly 75, 80 minutes from Austin. Or maybe a little more, maybe 90 minutes from Austin. And you'll see a number of them showing up. State College shows up, College Station shows up. Actually, when we were up there, Sioux Falls itself is a town with colleges. So they do fairly well. It's just I don't need to specifically target them from the student housing perspective.
The population data is way outdated on Google. Where do you suggest to get more updated data from?
So there's a bunch of services that basically you can pay for. So you can pay for Local Market Monitor. That's Local Market Monitor. You can also pay for Housing Alerts. That's Housing Alerts. These 2 services would give you more updated data. I think you're going to end up with the same list of cities.
So if I'm looking to invest in a suburb, do I apply these metrics to that specific suburban city or apply them to the nearby surrounding MSA metro?
You apply the rules to whatever is the largest city in a metro. And based on that, you can invest in a suburb. As I mentioned a little bit earlier, there's you can also figure out how well neighborhoods work, or you can look at a website called neighborhoodscout.com. Highly recommend it, neighborhoodscout.com, to look at the suburban neighborhood and make sure that suburban neighborhood looks just as good as the city itself.
Does gentrification and being
Oh,
out,
poll. We gotta throw up the poll.
oh,
Anna, can we throw up the
let's
poll?
please throw up the poll.
Yes.
Are you throwing that up
Um,
while I take questions?
no, actually, hang on. Let me go in here. It's not showing it for me. Can you
Okay,
do it?
all right. I will find it. Okay, there we go. Shh. Thank you.
All right. Please, take a look at the questions on the poll and answer us. They help us a lot. In the meantime, we'll take the next question.
Does gentrification and being outpriced change reduced crime rate?
Gentrification does reduce crime rates. I hate saying that because I feel that gentrification is primarily a negative thing. It forces people out. But speaking just from a statistical perspective, gentrification reduces crime rates. Yeah.
How do you look up what typical construction costs are for different areas? Great
There's
question.
no there's no easy way to look that information up. A lot of times we call local builders, local brokers, local civil engineers, and they have a sense of it, but you have to have a standardized product. Like you can't call somebody and say, what is the construction cost in your area? They won't give you a straight answer. So you might say something like, what is the construction cost in your market for a 3-bedroom starter home or a 2-bedroom townhome or a 3-story apartment? Then you might get slightly better answers. But as far as I know, there's no database in the US, paid or free, that provides that information.
Where is a good area for self-storage?
So self-storage is not correlated to population. Self-storage is actually, investment is correlated to how many units there are per capita in a particular market. So I would highly recommend that you do not use our data for self-storage. Like, for example, we have a we've done 2 self-storage projects, one in Utah, a smaller one, and then a much larger one in Memphis. Memphis is not a growth town in any way. There's 4 cities in that we look at, Chattanooga, Knoxville, Nashville, and Memphis. Of them, Memphis is clearly the worst. But we did the self-storage there because we're aware that self-storage is really about how many units do you have in a certain neighborhood versus how many people live there. And that metric is available through a variety of websites. Yardi Matrix provides data. So there's paid data and you have to buy it. You absolutely do not want to basically say, hey, this area has great population, I'm going to go out and do self-storage there. That's a very bad way of looking at self-storage.
We're going to get to the cities. Lots of people asking about cities, but I'm going to ask a few non-city questions first.
Sure.
Many 5 and 10-year lower interest rate mortgages are coming up for renewal and probably happening as we speak. So those would be commercial loans. What effect does this have on the market who had lowest interest rates for this period and now are forced to refinance to more than double their interest rates? Are they just selling out and getting out of home ownership, leaving inventory for investors like us?
Well, Anna, he's asking the question from the homeowner's perspective because he said home ownership,
He
right?
said 5 and
So,
10
so I'm,
lower
yeah.
interest rates. Okay.
So, yeah, also he said 5 and 10, which sort of doesn't make sense because most people actually are doing 30-year fixed. So when we are looking at the inventory that is due to come into the market for single family in the next 2 years, it's actually very weak. It's weak inventory because so many people refinanced if in 2020, 2021, and 2022. Such a large percentage of people refinance, even people that are refinanced before refinance, including myself, right? So I went from 3.25 to 1.75, that there isn't a huge amount of inventory that's expected to come on in the next 2 years. Obviously, the effect of COVID ultra low rates wanes, so it goes down every year. But we actually don't expect a balanced market for single family until 2026 or 2027.
Okay, for your usual quick city question. All right, so here we go with city questions. You ready?
Yeah.
Here we go. Charlotte, North Carolina.
Fantastic city to invest in. It's only second to Raleigh, sort of in our list in that area. So when we look at sort of the southeast of the United States, an incredible city to invest in. It's actually larger than Raleigh, so it's a bigger city. Terrific city to invest in. Obviously, prices are a little bit on the higher side, but overall, yeah, really, really good.
Houston, Texas.
So Houston's a good city to invest in, but I always tell people there's two sides to Houston. They don't have any zoning laws. So often Houston overbuilds, and it's currently overbuilding. So that there's 9,000 units scheduled for delivery in Houston this year. That number is not the largest in the US. Dallas has, 17,000 units, but Dallas also absorbs more because Dallas's job growth is higher and its income is higher. So it tends to have a higher absorption in Houston. So the challenge with Houston is because of lack of zoning laws, they often become oversaturated and rents fall. Right now is such a time. Rents in Houston are falling. So you have to deal with that. And the best way to deal with it is sort of to get your hands on a CoStar report. If you know a broker, they can sort of share that with you. And if you see a large amount of supply coming, maybe that's not a good time to invest in Houston.
What about Dover, Delaware?
Don't know enough. It actually came up in the list pretty high. Don't know anything about Dover.
So they said you pass it on the list.
Yeah.
What are your thoughts on investing in multifamily in Minneapolis and surrounding suburbs?
In general, St. Paul and Minneapolis, the Twin Cities, are fantastic places to invest in. I mean, I think they're amazing cities, great education. They're not going anywhere. The only thing that comes up in my mind is that Minneapolis just banned single family zoning. So essentially, everyone that had a single family can now build up to 4 units. So you want to keep your eye to see that not too many people are up zoning their units and making 2 or 4s. It takes a while for that ball to get rolling, so it doesn't happen immediately. But I'm afraid that basically Minneapolis, by banning single family zoning over 5 to 10 years, may have sort of fixed its problem. Well, if they fix their problem, then if you're buying there, well, that's not good for you.
What about Northwest Indiana, Hammond, Dreier, Schererville?
I think in general, the Northwest Indiana is doing really well. So, what's the other one that we were looking at there above Indianapolis?
I can't remember. It wasn't
Yeah,
mentioned there, though.
yeah, right. It didn't come up in the list so far. I'm just going to go to maps and take a look at that. So, but yeah, Northwest Indiana is actually, that area is doing quite well. So I'm overall impressed, and I think that as you go north in Indiana, you actually start seeing some really good stuff there. So I'd say yes. I'm not an expert on that area at all. So there's also Fort Wayne here. So as you go northeast, you hit Fort Wayne. So you might want to look at Fort Wayne, but also a little bit north of Fort Wayne. Yeah, some interesting stuff going on there as well.
How
Now,
about
part of that is because Ann Arbor's doing really well, Grand Rapids is doing well. There's a lot of interesting cities that are doing well in this area.
Fort Worth?
I think Fort Worth is worth it. That's all I'll say. Obviously Dallas is incredible. Basically, if I had $1 billion and I didn't even want to get a loan, I would put the biggest chunk of that money into Dallas, because on a 10-year basis, no city beats Dallas. Now, Fort Worth is next to Dallas. Well, I want to remind you that I'm not a huge fan of Oakland. I live in the Bay Area, but Oakland is next to San Francisco. And have you seen just how shockingly high Oakland's prices are? Fort Worth is piggybacking on Dallas.
How about Killeen, Texas? What do you think about Killeen now?
Well, actually, we 2 days ago, we saw a ranking of Killeen, because Killeen is gaining massive amounts of population. It was a huge number. It was like tens of thousands of people. Killeen is gaining tens of thousands of people from Austin. Austin's becoming as expensive as a Californian city, right? It's by far the most expensive city in Texas. And so people are leaving and they're going either south to San Antonio or they're going north to Killeen. So I think Killeen's a good investment. Challenging city sometimes because it has military, so your occupancy will go up and down. But if you're in for a longer haul, it's certainly one to look at.
What about Kansas City?
I think KCMO is set for a long-term growth. I think Kansas City, because of its industrial capabilities, I'm not a huge fan of the state of Missouri. I've hesitated to mention Kansas before, but we have picked it once as our up-and-coming city of the year. I think KCMO is on a good track. Both Indy and KCMO are going to do quite well.
All right, Neal, we have like 5 minutes or less left. And so
Okay, we'll do rapid fire.
you're on the clock. Phoenix real estate look for 2024.
Very poor outlook, large amounts of delivery. Buy at the beginning of 2025.
Denver, Colorado market.
Steady Eddie market. It's just hard to make cash flow.
Atlanta, Georgia.
Still a very good market. Affordability levels are the highest for any major city over 2 million. I think it's set for long-term growth.
Montgomery, Alabama.
Not a big fan. Look in Huntsville.
Detroit, Michigan.
I don't like cities that lose population, but it does have amazing suburbs.
Clifton, Texas, or Waco, Texas. Ugh.
Waco's okay. I just, Texas is spoiled for choice. You have so many options. I'm not sure I'd go to Waco, but it's doing well.
Is Tucson to be considered in 2024?
Possibly. If multifamily prices come down, you can look at it. Single family still seems too expensive in Tucson.
Southeast Michigan.
Southeast Michigan. Okay, well, let me see. What the heck is in Southeast Michigan? Southeast Michigan.
Well,
Not sure. So I'm just gonna say pass.
okay. Which tier 2 city should we invest in?
Tier 2 would be Raleigh, right? Because remember, you want to be under 2 million. If Raleigh is expensive for you, Indianapolis or Kansas City, they're both 1.7 million. So they're both tier 2. Right now I like tier 3 better, but yeah, those three are really good.
How about Chattanooga, Tennessee, and Northport,
So
Florida?
that's a tier 3 city, right? So I like it because if you look at Nashville, right? So that's a tier 2 city. Then Knoxville is sort of tier 2 city because 1.4 million people, it's almost tier 2. Chattanooga is 500,000 people, so that's tier 3, and I really like tier 3 cities. I think Chattanooga is a great buy.
Let's see. Any cities that you are staying away from in regards to global warming / wildfires?
I'm worried about global warming. I saw the ocean temperatures for 2024. They're bad. They're rising much faster, and ocean temperature rise leads to stronger hurricanes. So anything that you see, I mean, Florida obviously has exposure.
What about California? Any cities in California, Neal? What's your highest city in California? What's your best city in California?
Inland Empire. So I think if you're going to invest anywhere in California, go to the Inland Empire.
Let's see. Vegas has mostly transitional temporary jobs.
Yes.
Sorry,
And that is a known Vegas problem. You're going to have to deal with it. Your tenants don't stay very long.
Yeah. All right, Neal, maybe take a look at the remaining questions. I think we've kind of gotten most of them.
Good. We got them all done in time. So this is
We're
6:16.
9:15. We're sorry, 9:15 for me.
Well, 9:15 for you, 6:15 for me. So we'll just stop at this point. Thank you everyone for coming. Keep coming. If you have other questions, feel free to email them to us, and we'll be back with a very interesting presentation in the coming months. I'm going to talk about the myth around the demise of the US dollar. That if I ever heard a bunch of crock, it was that the US dollar is somehow not going to be the world's reserve currency. I'm writing that presentation. I'll invite you to it by email shortly. Thanks, everyone.
And as I said at the beginning, better than binging Netflix.
Nice. Nice. I love it.